Assalamu alaikum, everyone. Good morning, good afternoon, good evening, depending on which part of the world you're in. This is basically a follow-up to the IVSC, IVS Exposure Draft Standards consultation webinar that we had in May earlier this year. So back then, it was the start of the 3-month consultation process. We introduced what the proposed changes to the IVS standards for 2023, effective 2024 would be. And on that, it was a joint presentation with Alex, the technical director of the IVSC, and myself. What we're doing now is 10 days to the end of the consultation process. We're looking to basically take any questions you have, clarify points where clarification is required, so you can feed effectively into the consultation process. With me on the panel is Mr. Alexander Aaronson. He's the technical director of the IVSC. He's very familiar with the standards, and same as before, we're going to have an interactive session. Presentation will be with slides in Arabic. Presentation will be in English, so you can tune into the English channel. There's live translation in Arabic, so you can follow along in Arabic. The questions and answers session, you can pose your questions in either Arabic or in English. And with the help of interpreter Mohammed, who's on the line with us, we will ensure that all your questions are dealt with. My name is Wynful. I consult and advise on valuation matters for Taqiim. So I'll be your moderator for today. Over to you, Alex.
Thank you very much. Paco's being modest. In addition to his work with Taqiim, he's also a member of the IVSC Tangible Assets Board, and will be very happy to take any questions that come along, so please don't be shy. So I'm going to tell you a little bit about the international valuation standards and the exposure draft. So next slide, please, Paco. So what is IVSC's mission? So our mission really is to work with our partners, including other standard setters, regulators, valuation professional organizations, valuation service providers, and the end users of valuation information. And our mission is to build trust in valuation by two very important parts. And the first one, which is what we're really dealing with today, is establishing globally consistent, high quality international valuation standards across all asset classes. And we also try and encourage quality valuation professionalism globally. Taqiim are very good exponents of this. You have very good professionalism within your organization. And by achieving these two aims, what we're really trying to do is to support business, strengthen financial markets, and protect the public interest. And we're really talking about global public interest when we talk about public interest here. Next slide, please. So we embarked on this journey at least, I would say, a year or two ago. It's quite a long journey. Standard setting is never a static process. Standards need to evolve to meet market needs. And we got feedback, first of all, from our agenda consultation, which published in 2020. And in that, we highlight our short, medium, and long-term goals. And we highlight key topics that we'll be looking at in terms of the revisions to the standards. And we very much ask for their market's input. And we published as well our summary of responses in relation to that agenda consultation as part of a very transparent standard setting process. In fact, just to illustrate how standard setting never changes, Paco and myself in the Tangible Assets Board are already discussing the next agenda consultation that we will be looking to publish in 2024. And we also had feedback from the market. You know, through market engagements, a lot of stakeholders told us what revisions could be made to the standard. So what we tried to do was modernize the standards to include key components of the valuation process that continue to be more important in determining values. An example of this is data and inputs. We're asked to do more and more things. We're asked to do things in relation to environmental, social, and governance that I'll discuss later. And data is very much part of this process. And we also realized that we needed standards in relation to models. And data and models are very much interconnected. In the UK, we have a saying, rubbish in, rubbish out. To a certain extent, your model will only work effectively if the data that you put in that model is effective. We also wanted to increase the understandability and relevance of the IVSC standards to users and other stakeholders, such as financial institutions, investors, and regulators. In fact, at the beginning of this process, we had a discussion. Are they international valuer standards, in which case they should only relate to what the valuer does, or are they valuation? And the proof, as you can see here, though my Arabic is not good, is that they're international valuation standards, and valuation is a process. And there are many people involved in this process other than just valuers. You may use specialists such as intangible assets. It's quite common that Paco and myself might use the services of a building surveyor. You might use data providers to look at tenants' covenant strengths and other bits within the standard. And so we wanted to make sure that our standard is equally relevant, not only to all those who provide us assistance in the valuation process, but also to the users of the valuation, the intended users, the investors, and the other parties. And finally, we wanted to future-proof the standards. Now, you can never really future-proof a standard, but we wanted to make sure that it was sufficiently flexible to incorporate the valuation of new and different assets and liabilities. Next slide, please, Paco.
Sure.
And just while we're talking through this, I'm just reminding you, this is very much an interactive session, yeah? I'm very happy to talk, as Paco will tell you, but if any point you have questions into anything that we say, please feel free. You can post them on the Q&A. I believe you can ask them as well. We're happy to deal with them at the time that they come. And if they come in Q&A, we have the translator as well, who will help provide a translation to us. So you don't necessarily have to ask us the questions in English. So looking at the IVS enhancements, and these are very much enhancements to the standard. We haven't made major changes except for the inclusion of some new sections that I will talk you through. What we've done is we've juggled some existing sections within the standard. So first of all, we wanted to ensure the general standard applied to all asset classes. So what that means is it equally applies to financial instruments, business valuation, plant and equipment, tangible assets, personal property, etc. And if it doesn't apply to all asset classes, it's not a general standard. It belongs in the asset-specific standards. We also wanted to provide clarity to users and other stakeholders, valuers, clients, regulators, and investors. And we also felt that we needed to better describe the interrelation between the IVS general standards and the asset standards. I think we've had one question so far, which is, can I have a translation? I believe that there is a channel that they can go on, Paco, is that right? Where the it is actually in Arabic, and yes, we can make the slides available to you afterwards. So
yes,
go ahead.
Yeah,
Paco.
so just to chip in on what Alex said, there's a button, it has a globe on it in terms of the language selection. You can pick English, you can pick Arabic. If you select Arabic, you should be hearing the live translation in Arabic, moving in tandem with the presentation. So yeah.
Brilliant. If we can move to the next slide, please. So what I really want to deal with here is valuation is a process. And we had a lot of discussion across the boards because we all do slightly different things at different times, particularly when you compare financial instruments valuation to tangible assets valuation or business valuation. But we recognized that we all followed the same process. And you can see the process in these circles at the bottom. So what we tried to do was agree a valuation process that applies to all asset classes, and it describes the key processes in which we believe we need to have standards. So looking at the circles at the bottom, you can see that we have our valuation framework. So these are overarching principles over which a valuation must be made. They include sections that I'll go through on core principles of valuation, valuer principles, quality control, and compliance. We all have a scope of work or a terms of engagement, and that's contained in IVS 101. And once we've done our scope of work, it will often define our basis of value. And what I mean is, if it's secured lending, we're more likely to use market value. If it's for financial reporting under IFRS 13, we would be more likely to use fair value. And once you have your basis of value, you begin to look at the valuation approach that you're going to use. Is it the cost approach, the market approach, the income approach? And then once you've decided your approach, you begin to look at your data and your inputs, IVS 104, and think about the models. Now, to a certain extent, and you'll see this when I go through the chapters, data and inputs are interconnectable. So sometimes I'll look at my data, go to the model, realize that the data doesn't work in my model, and then I will come back and look at different types of data. Once we've done that, we have our documentation and our reporting. And then you need to look at the specific asset standards. So for example, if I was valuing a development property, I would need to comply with all of IVS 100 to 106, as they're the general standards that relate to everything. And then I would probably have to look at IVS 400, real property interest, and IVS 410, development property. And by complying with all these bits of IVS, I come out with an IVS compliant valuation. So the other things that we've tried to do in the way that we've set it up is we've created flexibility to bring in other additional asset standards as they're needed. But remember, IVS is principle-based and overarching. So the only reason we bring in additional asset standards is if there is something different in the way that that asset is valued. Otherwise, the general standards and asset standards within IVS apply. Next slide, please.
Alex, before we move to the next slide, I believe we have one question.
Let me just look at the question, because all I can see is a full stop.
Yes, I was going to say the same thing. So Abdul Wahab, there's just a full stop. If you could type in your question, or yeah, let's see if we can give you an option to answer it live, then that might help, or to ask it live and then we could answer it live. Just give me a minute. Let's see.
And while Paco does that, I'd just like to make the point, you know, I've been in many presentations where people don't want to ask a question because they feel they might look silly, or it might not be the right question. There is no wrong question, and both mine and Paco experience has been that question you're worried about asking, probably 60% of the audience want to ask too. So it doesn't matter what the question is, please feel very free to ask both of us. So the slides are all in Arabic. Is there a way to view the version in English? And the other one was a test message. I can tell you that the test has passed, so thank you very much for that. You're safe to send messages. in terms of the slides in English, it might be a bit complicated while we're presenting, but we do have an English version. I'll see if Paco can send them to you while we're doing this, but if not, we will send them to you directly afterwards. I'm actually looking at an English version of the slides because otherwise you wouldn't get that much information from me. So yes, slides are also available in English, Michael, and we'll see if we can find a way to get them to you. Will it be uploaded on the Taqiim YouTube channel? I hope so. I do like being on YouTube. Is that a yes, Paco?
Yes, it will be. So basically, once again, for a recap, which I gave at the beginning, the same presentation with minor tweaks was given back in May, on May 22nd or 23rd, if I recall. And slides, it was on the Taqiim YouTube channel, and the slides were also made available to participants. So this is a follow-up at the end of the consultation process. So yes, there are English slides available. And yes, if you didn't get access to them in the first session, which was back in May, they will be made available to you after this session through the marketing and communication team. Thanks.
Okay, and we've received a very reasonable question. The asset standard is after 106. May I know why it's not before documentation? And the reason is, when we look at the general standards, they apply to all asset classes. So yes, obviously, you would be doing your documentation and reporting after you look at the relevant asset standards as well. But the reality is, not everyone will be using these specific asset standards. There's some classes where the general standards will be all that people need to look at. For example, we don't have a specific section on art and antiques. We did do a perspective paper on the art of valuing personal property, but in those cases, you would be looking at the general standards. So the general standards show the whole process. The asset standards are additional standards that you need to comply with in addition to the general standards. So I hope that helps. We thought it would be confusing if from IVS 105, we then went through IVS 200 to 410 before going back to IVS 106. So that's the way that it is. There's a question that's come up in Arabic. So if we can get someone to help us translate that, then obviously we'll deal with that question. But in the next, in the interim, if we can move to the next slide, Paco.
Sure. There we go.
There we go. So we're talking about the IVS review considerations. So when we were looking at reviewing the standards, and it really does go back to my comment that standard setting is not a static process. We write standards to meet market needs, and market needs change. Technology advances. I mean, both Paco and myself have been looking at ChatGPT to sort of understand AI and what it means in relation to valuation. And this might be something that will come up in our agenda consultation next year. It may be something we have to look at in future as it develops. But so we were looking at ongoing changes in global markets and global valuation, including the increased use of technology and the abundance of available data sources. Not all that data is good, you know, which is why we have a way that you could look at the characteristics of data and make sure that you're using the correct data for the purpose. There's also an increased use of specialists and service providers by valuers in the performance of their valuations. In fact, I was having a discussion that I was telling Paco about with an associate professor of ESG based in Australia. And one of the things we were looking at is some of the things we might be bringing in an ESG specialist in future, in the same way that we have a building surveyor to advise us on faults within a building or issues with the property. Is there subsidence? Is there settlement? What are the refurbishment costs? So we thought that we needed to have standards that reflected the increased use of specialists or service providers such as rating agencies, and the performance of our valuations. We also noticed that there was an increased demand by stakeholders, including financial institutions, investors, and regulators, for not only clarity regarding the valuation process, but also the management of valuation risk. And Paco is part of a working group with me where we're looking at this topic. And if he's not part of that working group, I'm going to pretend that he is. But actually, what is IVS? It is a valuation risk management process. And we feel that we need to look further at the nature of valuation risk, because you could do everything perfectly, but there will still be inherent risks within a valuation. There may be liquidity risk, there may be market risk, there may be process risk. So one of the things we're really going to look at is the nature of valuation risk within a valuation. We also notice that there's additional demands on valuation professionals to address new types of assets or liabilities, and to expand the application of valuations into areas such as environmental, social, and governance. For example, the International Sustainability Standards Board, who are like a sister organization of the International Accounting Standards Board, have just issued S1 and S2 in relation to consideration of environmental factors and climate change in financial reporting. And we also wanted to integrate our new financial instruments content. Next slide, please.
Alex, before we move on to the next slide, with Mohammed's help, it would be great if we could have a live translation of the Arabic questions, and then we'll answer them in English so they can be live back translated to the questions, to the people who ask the questions. So Mohammed, could you, thank you, Mohammed. Could you translate the questions and then we'll answer them, Okay, thank you, Mohammed. Alex, you want to take a shot at that first?
Yes, what is it though? I didn't hear what he said. My apologies. What was the question?
Yeah, hello. Alex, can you hear me?
I can hear you, but I couldn't hear the question.
Oh, okay. Yeah, so Mohammed, could you please repeat the question here?
Do I need to click on the globe to hear it?
All right. So just so we work around the IT issue, Alex, I'll just repeat the question for you.
Thank you.
The question, the gist of it, at least the way it says, how come the IVS is not used in all parts of the world? So case in point, in Egypt, they have their own standards which differ or are a bit different from the IVS standards. The questioner wants to know why this is the case.
Okay, it's a very good question, and I can't go specifically into Egyptian standards. I know that if we had Ahmed Sabri here, he would very much be able to give you chapter and verse on the Egyptian standards. And we will deal with that a little bit later as well when I talk about compliance. But IVS is overarching principle based. So in order to comply with IVS, you also need to comply with the laws and the standards in the market that you operate in. So we call it any authoritative, regulatory, or legal requirement. So, for example, in the UK, if Paco and myself were dealing with rating valuation, so that's local taxation for offices and other buildings, there would be particular requirements that we would need to follow, that we would have to do to be compliant with IVS, because they're within the laws of the country. Now, the other side, which I know does not apply to Egypt, but it may apply elsewhere because we are an international standard, in some markets, they're still developing valuation techniques, valuation professional organizations, and they may not have that sophistication within the market at the moment. But IVS is international, it is globally recognized, and it is the overarching standard for valuation. But you can get some regional variance, but you shouldn't get variance that actually contradicts the valuation processes within IVS, but you always have to follow the laws in the land. I don't know, because you directly work in those regions, if you want to add any more, Paco, from your insights in relation to it, but that would be generally the answer that I would give.
And generally, I believe that answer is right. Yeah. So like you said, IVSC, umbrella organization, overarching standards, local standards, which are more granular and applicable to that region, but compliance with the local standards and also local law and regulation ensures compliance with the IVS. So that's, yeah, that pretty much sums it up. Thanks, Alex. And thanks, Mohammed. Could we have, yeah. Yes, that's what I was going to ask you to do. If you could give me the next Arabic question, and then yeah. Okay, thank you. No, I'm actually quite clear on that. We've had it quite a few times, not necessarily in this forum, but in different ways. So, so the question, the person. No. All right. Is that one question, or there's a second part to the same question? All right. So let's finish this, and then we'll get to the next one. And then once we're done with Arabic questions, we'll move to the English questions. Right. Yeah. So basically, what the questioner is asking is, according to the Taqeeim regulations and the IVS, right? If they do evaluation and they use two different approaches and methods, can they strike an average between the two approaches or the methods within the approaches to arrive at a value conclusion?
Okay, so I always get concerned, Paco, when that question is asked by the use of the word average. So for example, I remember being in one government office and they told me that they had two valuations for the same property, one of 10 million and one of 90. And I said, what do you do? And they said, we add them together and divide them by 2. And I looked at them quite shocked and I said, well, what if one of those responses was actually correct in terms of the valuation? So we do talk about weighted average. We do talk about weighting, you know, and I often have used, as Paco has, more than one valuation approach, particularly if I feel that there's uncertainty, it's more checks and balances. But I think you've got to be very careful when you think about averaging, because first of all, the word average is the wrong word. We will use weight. You might weight your results some way, but it's quite difficult to do. I would just look at other approaches to get some sort of certainty in it. At the end of the day, I am giving my opinion, but I wouldn't say that weighting is wrong if it's done correctly. But Paco is more familiar with valuations in your market, so I'm going to switch over to Paco and see if he wants to add anything to that.
I 100% agree with Alex on that. Pun intended in terms of weighting, yeah. But yeah, so basically what Alex is saying is you may have 2 or 3 approaches. Look at the data and what you assembled in terms of data and inputs for your evaluation. You may well find that, say you're using a market approach or a direct cap or a DCF within the income approach, the data you have is pretty solid, right? There's no rule in the market that says if you have pretty solid data, you cannot use one approach or one method within an approach to arrive at a valuation conclusion. Cross checks are all well and good, and I would recommend that in most cases, if you run 2 or 3 methods or approaches to value, or methods within the approach, chances are you've run your cross checks, you stress tested your valuation more, and you're more likely to come out with an outcome that is good. But what that may tell you at the very end of the process is, you know what, I did 3 methods or 3 approaches to valuations. One I'm 100% confident in, or I'm super confident in. And at that point, like Alex said, rather than weight it, you can, rather than average it, you can assign 100% weighting to the one you're most certain in. And if there are 2 approaches or methods that you use, which you are equally certain in, then theoretically, if you're equally certain about the two of them, they should be coming pretty close in terms of value anyway. So same difference, you're going to have a very minimal tolerance range in there, plus or minus 2%, etc. So once again, you can then use that for your valuation conclusion. But just be careful about averaging, because one may be totally far out. Specific to this market, what I've seen is, because a lot of valuers cut their teeth on the cost approach, what's happening is, a lot of the times when you're looking at a particular type of asset, once again, horses for courses. If it's an investment and if it's an income generating asset, I would say go with the income approach, because that is how the market would treat that approach, would treat that asset, and that is how investors would analyze it themselves. So you may actually, and I've seen that in application where there's close to a 70 to 80 to 90% difference between a cost approach and an income approach. But depending on the pressures, sometimes one approach is preferred either by the client or by the valuer. All I'll say is be careful. Valuers don't make the data, we reflect the market data. So go with the one where your inputs are sound, where it really reflects the market conditions, and then come out with your valuations. If you're able to defend it and you can justify and support it, that is the correct value. Yeah. So
if I could just add to Paco, when we were young, which probably is going back a few centuries, but we were very much taught the cost approach is the method of last resort. Now, that's not necessarily true, but the point that it was trying to make is cost doesn't necessarily equate to value. So let's say I've got a villa in Riyadh, yeah? Now, according to my wife, I can't tell you whether it's true or not, I have terrible taste. So let's say I spent 1 million on doing up the villa in my taste. It would not necessarily add 1 million to the value. In fact, my wife's view would be it might reduce the value, because my taste is so bad, people will look at that and they'd actually look at less. So there are very good reasons to use the cost approach. It is a very effective approach. Sometimes I'll look at it to almost set my limits. Well, it's not going to be higher than that because the cost of rebuilding it is this. But remember, cost does not necessarily equate to value. So always think of that when you're thinking about the cost approach. Though it's an approach that both Paco and myself will have used many times, but we will be using it with caution.
Yeah, thanks, Alex. And just to add to Alex's point before we move on to the next question on the cost approach, in terms of application, if it is done right, once again, the inputs that you're putting into the cost approach, be it the value of the land, be it the build cost, etc., they are market derived and market driven. And when it gets to making your adjustments for depreciation, beyond just depreciating for wear and tear, it also gives you leeway to make adjustments for functional obsolescence. So back again to what Alex was saying, if it's been done up to a particular person's tastes, which the market would not pay for, you can actually factor into that, stripping out those assets. So let's say you're using a warehouse, right? Or an industrial facility, case in point. If it is configured for, let's say, pharmaceutical productions, you're going to have a lot of clean rooms, interspatial spaces, which are over and above the cost of a regular warehouse or industrial shed. If it is value and use, basically for a business, or you're looking at fair value and continued use, those inputs are of value. To the average or the general market participant at the point where that business is winding down, it is actually a cost. So they'll need to strip out the pharma-specific assets which have been baked into that building at a cost. So the value then becomes very different. But once again, like I said, the cost approach, when used right, allows you to make adjustments which you may not be able to make with the other approaches. Once again, for fair value reporting, if your mandate requires that you give the clients remaining useful lives, you will need to establish an economic life for the property. And then once you've done your depreciation and obsolescence adjustments, you will let the client know what the remaining useful life of those assets are. Once again, an approach you can only do, or a value conclusion or inputs you can only arrive at by using the cost approach. So it is market driven. When used right, you will come to an accurate conclusion of value. right? So it's not a method of last resort. In some cases, it may actually well be your only method. Yeah. Thanks.
There's a question in English I can answer. We've got a question here. IVSC is translated to other languages, excluding Arabic. Is this translation reviewed by IVSC? And if so, is it used in Arabic-speaking countries? So the way that we deal with translations is our member organizations will translate it into their language. And we will make sure that there's only one translation per language. So for example, we wouldn't have different translations for Brazilian Portuguese as opposed to Portuguese from Portugal. And our member organizations, I know that Taqiim put a lot of work into doing the translation and making sure that it's fit for purpose. But if there is a dispute, we would always ask people to refer back to the English standard, you know, the English version of IVS. But yes, it is translated into a number of languages. It's translated in a voluntary basis. I believe that the Arabic translation is made available across the Middle East, Paco. And yes, if you have other languages, it will be in French, German, and other languages, and organizations will approach us for the translation. There's another question in English. I mean, I don't know if we'll make it all the way through this presentation, but neither me and Paco are worried about that, because we know that we've given you the presentation before. We know that it's available on the website. So it's really important for us that we do get to answer these questions, you know, so we will devote as much time as is needed. And our feedback to each other the last time we presented was it was a shame there were a lot of questions that we couldn't answer. So it's good that we can do it now. So what is the IVS standard in valuing startups? Well, that is a very good question. So firstly, I would say that you should look at IVS 200, business and business interests. And you probably need to look at IVS 210, intangible assets. But let's say if we talk about technology startups or internet startups, I know that 90% of these fail. It's really difficult to value. And when I've been discussing with business valuers about how they do it, they say, we look at whether they're reliant on just one product. We look at their research, we look at their investment, because I may have the best program that does something wonderful in the world and have the intellectual property and everything else. But as soon as someone releases a better program, that program could become redundant. So what you're very much looking at is, what are their plans for the business? How do they intend to grow? You know, are they relying on one product, or do they have research looking into other products? Is there variance in relation to that? Now, we do perspective papers where we engage the market on issues. And if you feel that it would be useful having this perspective paper on startups and the valuation of startups, you'll get that opportunity either through our agenda consultation, or if you send an email directly to Paco or myself, we can almost make it available to the relevant board. But, you know, a startup shouldn't necessarily be valued differently from everything else. You should follow the general standards. You should follow IVS 200, business and business interests. You should follow 210 intangibles. And also, you know, if there's inventory or other elements, you should follow the relevant standards in relation to that. I don't know, Paco, if you want to add any more to that. I don't know if startups are a massive thing in Riyadh, but I do know they're difficult to value.
Yeah, your answer pretty much encapsulates it. The IVS 200s, which are in and around business valuations, intangible assets valuations, which will basically encompass business enterprise valuations. Yeah, so that pretty much sums it. And once again, just to harp on the point which I've been talking about for quite a while, current IVS standards, which we're all practicing to the IVSs, which were effective in 2022, January 2022. This consultation is geared towards you guys looking at the exposure drafts, which has been open for consultation for 3 months. They will be finalized and will become effective around the middle of next year. The finalization process will be completed this year into early next year. So if you do have additional questions or inputs to further strengthen the standards, this is your opportunity over the next 10 days before the consultation process closes to actually look at the general standards and your asset specific standards and give us feedback so we can constructively improve them for your use. Yeah, thanks.
Pakel, before I hit the next Arabic questions, or maybe we move on a little bit and then come back to some of them, there's one here that we can answer quickly from Raid, and that's, as a member of Taqeem, can I register this attendance as experience hours? I'm assuming that's a yes or no, so you'll be able to answer that.
That's fairly straightforward. It is a yes, you get 2 experience hours for this. So yes, they'll be accredited to you, and yeah, you can register them. Thanks a lot, Raid.
Okay, what do you want us to do, Pakel? Shall we move forward a bit, or shall we take a few more questions? If I'm using the income approach, does it make sense to use 2 approaches? Well, it's really down to the data that you have available. Now, when we look at IVS valuation approaches, you'll notice that we talk about certainty, you know, and in instances on uncertainty, we would always recommend the use of more than one approach. Even within the income approach, you'll notice there's a number of methods. I could be using a term and reversion into perpetuity. I could be using a discounted cash flow. So it's not a yes, no answer. It really depends on the confidence that you have within the data, the confidence you have within the approach that you've adopted. And to a certain extent, you'll notice that within IVS 100, which is the valuation framework, we talk about quality controls, and we had a lot of discussions over whether an individual valuer can do quality control, and we believe they can, you know, to a certain extent. You know, you should think about a valuation, maybe review it the next day, you know, so you should hopefully be able to answer that question yourself, because there is no yes, no answer. You should, when you review and challenge your valuation, have a look at your data. Are you confident in the market evidence that you've got? Does it make sense with other similar assets that are selling in the market? Does it sort of equate in terms of the yield adopted or the growth rate or the other factors that you've used? So we're not saying that you always need to use more than one approach, but often it is good practice. It's very rare. I mean, maybe in my report, I'll only mention one approach, but my documentation will often show that I've looked at it several ways before deciding on what that solution. It sort of relates a little bit to the weighting question that we have as well. But over to you, Paco. I'll see if you want to add anything more to that, because I think that's a good question.
Yeah, I agree with Alex. First things first, basically, it is not mandatory, like Alex said, but it's recommended best practice. And the reason why it is recommended best practices, it will give you, the valuer, more confidence and more certainty in your valuations. So the simple test is, would a competent valuer be able to assemble the data and inputs to run 2 different approaches or 2 different methods within an approach, right? One as a test to the other. If the answer is yes, and the data is obtainable by a competent valuer, that is going to be the test for a reviewer, because a reviewer who's looking at your work, be it in case of it being challenged in court or in case of a complaint coming against you, will be at that valuation date, will the competent valuer have been able to assemble enough data and inputs to basically stress test this and say that this valuation conclusion, I am certain about it because I ran more than one approach or more than one method to give me comfort. If the answer is yes, and you are a competent valuer, then you should be able to do that, because that is always the test in the marketplace. The more data you have, the more you've run cross-checks on your valuation, the easier it is to defend it if it comes to that. And that ties in directly to what Alex was saying about data and inputs and also documentation. So challenges come to valuations sometimes 5 years down the line, depending on the statute of limitation in that country or how long you're required to keep files. It could be 7 years down the line, it could be 10 years down the line. The more you have on file to defend it and the more work you put into it, the easier it is to defend your valuation. Yeah.
And that's why we have a section on documentation if we reach there, but if not, don't worry, the slides are there. We want to deal with your question, but the documentation at the end of the day is your defense. There's always more information in your documentation than there is in your valuation report. And if not, there should be, to be honest with you, because as Paco pointed out, if things go to litigation, if they go to legal dispute, it's not at the time you do the valuation, it's probably several years later. And you will have probably done many valuations since then, and you won't remember exactly what you did and what you didn't do. And that documentation that you keep on file, that is your defense. That is your defense if things go to legislation or other matters. You know, my report, for example, will refer to the comparables I used within my valuation. My documentation might refer to all the comparables, indices, and other elements that I considered. So don't be afraid to really fill your documentation. At the end of the day, it is that documentation that will protect you if there's an issue. Shall we move a little bit forward, Paco, and then in about 10 minutes stop for the next tranche? How do you want to do it?
I think so. So let's move forward. In 10 minutes, once we come back, Mohammed, it would be great if we could take all the Arabic questions at that point. After that, and then we'll continue with the presentation. So so next 10 minutes, we'll continue with presentation. Then we'll take the Arabic questions first. And then once those are done, we'll take the rest of the questions,
But really don't worry about asking questions. Both Paco and myself are very happy to receive these questions, and we'd much rather do that and deal with these issues and work through with you. So when we overview the revisions that we've actually made, and I'm going to try and be quicker on these parts to make sure that we get the benefit of your questions, but we wanted to adopt a structure that better aligned with the valuation process. We wanted additions or expansions to the requirements for data and inputs, valuation methodology, quality control, and documentation that we just talked about to reflect the increased complexities of valuations. We're being asked to do more and more. We do recognize that. Valuations are becoming more sophisticated. We've removed requirements between the general and asset standards to ensure that general standards are actually general standards. In fact, that means they apply to everything, not one particular discipline. We've also added appendices. Not only does this improve readability, but it gives more flexibility to our standards. We've clarified the roles and responsibilities of the parties involved in valuation, such as service organizations and specialists. And we've done substantial enhancements to IPS 500. Next slide, please. So we're looking at the structure of IVS, and you can see the structure that's up here, and one of the points that I'd just like to make, because I don't want to stay on this slide, is the appendices are also mandatory. So just the fact that they're called appendices doesn't mean it's part of the standard that you can ignore. They're still a standard. It's just that it's flexibility. So we may have decided that the methods in terms of valuation approaches, some of them are asset specific. Comparable transactions method is probably more an approach that would be used for tangible assets. When I look at discounted cash flow, that goes across all our asset classes. So what we tried to do was move the methods, for example, to an appendices, but the appendices are still mandatory parts of the standard. Next slide, please. So you can see here the structure of the general standard. So we start off with valuation frameworks, scope of work. Now, under basis of value, we've created two appendices, one which sort of gives the A to O for definition, such as when you take market value in the definition, each word is analysed and what that word actually means within the context of the definition. We've also created an appendices that looks at premises of value. For example, highest and best use, existing use value that we talked about, liquidation, for sale. These are different premises that apply. So for example, let's take market value. I could be looking at, let's say, an industrial building. And if I knew that it was legally possible, financially feasible, and physically possible to change that building to a residential, and that would produce a higher value, under the principles of highest and best use, I might be looking at that asset as being a residential building. So that's different from existing use value. It's the principle that we've always got to think of highest and best use when we're looking at assets. You know, valuation approaches, we've separated the approaches from the methods. People were confused. What's the difference between an approach and a method? It's quite a common confusion. In some languages, it doesn't even translate well. So just to be clear, there's three valuation approaches: the market, cost, and income approach. And underneath that, there are a whole variety of methods that we can use. You know, discounted cash flow, for instance, which I mentioned, is one method under the income approach. So that is the clarification. We've got data and inputs, and we've added a new section on ESG, as well as data and inputs being a new chapter. We've got a new chapter on models, and reporting now includes documentation. So just moving forward a little bit to the glossary, I just wanted to point out, so next slide, please. When we look at the glossary, you'll notice that there are a number of definitions here, and I really just wanted to point out a few of them. So the first one is, how does the standard work? Well, you'll notice that we've moved to a two-tiered hierarchy. Now, what I mean by that is we have the words must and should. If you see must, it means comply. If you see should, it means comply or explain. There may be some reasons why you might do something. For example, the question that we were asked in relation to Egyptian law, and where there might be variance. You might see a should and say, actually, I haven't done this because the law requires me to do this. Now, the other thing I wanted to point out with the definitions is not only are they shown in italics in the standard, but if you hover over a definition, the definition appears. We've tried to make it as user-friendly as possible. Now, there's a few other definitions that I'd like to point out quickly, and then we'll move forward. The one thing is intended use. Now, this is probably one of the most important aspects of our valuation because it will largely define the basis of value that we use. So is my intended use secured lending? In which case I'm probably looking at a market value, unless I was in Germany where they have mortgage lending value as well. Is the use for fair value? If so, what type of fair value? Is it IFRS 13, in which case I should follow that definition? But there are other definitions of fair value in the market, such as one supplied by OECD. They have slight variances. So please, you know, check what the intended use is, because it will help make sure that you get the correct valuation. And the other side of that coin is two parts, is the intended user. You know, that will also, why are you doing the valuation? Is it for lending? Is it for investment? Is it for taxation? Is it for financial reporting? So these are two key definitions we see within the standard. The other definition that I wanted to bring up, and then I'll jump to Paco, is professional judgment. You know, a lot of the work that we do is in relation to the professional judgment that we make. There may be a number of comparables that we have, but what makes us choose one comparable over another? And it's down to our professional judgment, our experience of the market, our experience of the valuation. So we've defined professional judgment within the standard, but over to you, Paco.
Thanks, Alex. Just to touch on what you said in relation to intended use and intended user, I cannot begin to stress the importance of these two factors in shaping your scope of work. As a reviewer and as a standard setter, one of the major issues we get when we look at reports which come up for review is the fact that the purpose of valuation is not clear. If you know what your intended use is and who the intended user is, you will make that as explicit as possible in shaping your scope of work, which will then in turn determine your basis of value, the approaches and the methods to use to achieve your valuation conclusion. So we come across a lot of times where, purpose of valuation, it just states internal purposes. Internal purposes for what, right? It might be to a board, it might be for internal decision making, but you need to clarify what the intended use is for. All right, internal purposes is not a use. So just be explicit. We say this because from a liability standpoint, valuers own the valuations that they make. You are the independent advisor to that company, to that individual, all right? You need to disclose enough to ensure that you're covered. I'm not saying give all the details of the company's internal workings or stuff that you are not allowed to talk about, but be specific and explicit in determining what the intended use of your valuation for is, because that will influence your basis of value, your approaches to value, your methods of valuation, and it will inform your value conclusion. So I can't stress that enough. Yeah. Thank you, Alex.
No trouble. And I'll just add a little bit to what Paco said. Let's say your internal use, you're doing valuation for a development company of their assets that they have, but they report on those assets. They put them in their financial report. Suddenly, your liability has moved from just your company to everyone who reads that financial report. And let's say they're actually quoted on the stock exchange, they're a REIT, they're a real estate investment trust or whatever. Suddenly your liability is everyone. It's all the public who could supply shares. So what I'm doing is just trying to reinforce, it's very important that you're aware of the intended user and the intended use, because to a certain extent, as a valuer, you also want to protect the liability that you're creating and make sure that your liability just doesn't go to everyone. Now, in some markets, we have professional indemnity insurance, so it's very important. You actually have to have insurance in relation to your valuations, but it's extremely important that you give as much clarification as possible. And then, Paco and others at Taqiim will be able to help and give advice in relation to that as well. We've received one question, which I'll just pause at before we move forward. Partly because it's in English, a little hint, if you want your questions answered quicker, Paco and me probably find the English ones easier, but don't worry.
Just a slight interjection on that.
Yeah.
Alex, once you finish with the English one, we're going to move on to the Arabic questions and answer them now that we've taken a pause, and then we'll go back here.
I think that's perfect, because the main thing is we want to hear your thoughts. So we've got a statement here that's very strong. A competent valuer should be able to provide one robust methodology in most circumstances, even in the Middle East. Well, I would say the Middle East is a very good market compared to many that I've seen, so I wouldn't necessarily put the even there, as most are income generating assets. The trouble is the second approach gives excuse for practitioners to use the land plus cost approach, which is then driven as the primary valuation approach, with the income approach becoming a secondary approach. This should never be the case, only in very exceptional circumstances. So I'll start off and quickly pass over to Paco. First of all, both of us would look at valuations individually. Unfortunately, the nature of our work is every asset is different. So it's not possible for me to give one prescriptive rule and say you should do this. It's very much down to your professional judgment, sir. And it will depend on the quality of the data, the quality of the information that you've got in relation to the income and other things. I think that where there is an element of uncertainty, you could potentially use another approach, but it doesn't have to be the cost approach. There is something called the market approach as well. that you might find useful. You might, you know, try and look at it in the currency per square meter or per square foot. Sorry, I got confused. I couldn't remember if it's dinar in Saudi Arabia, but
it's reals, yeah.
Reals. So it would be reals per square meter or per square foot. I might be looking at the yields. I might be doing other comparisons. What I would say, and I'm going to give the answer of Singapore. I don't know why, I just fancy taking you into another region, a little bit of globetrotting there. But in Singapore, the residential apartments are very, very similar. It's a liquid market and they're frequently traded. So in that situation, I would probably never move beyond the market approach. But in most situations, there is an element of uncertainty. And just because I look at another approach doesn't mean that I give it 100% weighting, doesn't mean that I average it. It might just be that I'm looking at my best and worst scenario. So I can't say that, no, you should only ever use the income approach because your information is perfect and everything else, because that's not something I've ever seen in my experience, perfect information. But that would be my answer. But over to you, Paco. See if you want to add a little bit more on that, because it seems to be a regional issue from what we've discussed.
Yeah, I mean, like you did say, it is a very definitive question, but just touching on the income approach first. You cannot use an income approach for every property. It may not be an income generating property, so that pretty much negates the use of that approach. And you cannot even create a hypothetical scenario where it would be an income generating property. So you do not always have to use the income approach. But once again, you are right, horses for courses. If the property is income generating, you should be looking at what you're doing the valuation for and what best fits that asset. If it is income generating, say you're looking at hotels, for instance, that data is available in the marketplace, and you can actually buy commercial data in terms of data sample sets for the type of hotel you're analyzing, and it will give you all you need in terms of running a robust discounted cash flow approach, or, well, it's not my favorite, but even a direct cap type income approach. So yes, I've seen a lot of cases where the cost approach is used as a primary method in the region. If it's done right, it can give you the right answer. But also, to add to that, I've seen a lot of disconnect between an applied cost approach and an applied income approach, where sometimes, like I said, the value difference is trending towards 100% difference. If you ever get that situation, you should be asking yourself the question, am I running both approaches right? The answer may very well be no. And if you're running both approaches right, or you think you are, then ask yourself the question, are the data inputs valid or are they relevant? Because you should never have that huge a disconnect. If you can run a good cost approach, by all means run it. Alex and I have both talked about cases in which your cost approach becomes the primary method. If it's non-income generated, let's say if it's a listed asset that you cannot derive revenue from. In the region, you might have places like Alula, etc., where it's being commercialized, so those assets could generate income, and the income may well be enough to sustain the valuation in the business. On the other hand, you may have assets where it's so one of a kind that you need to basically go back towards looking at a detailed cost approach. Case in point, you look at the UK. Houses of Parliament are going through refurbishments right now. Initial costs were supposed to be in the region of £7 billion. Now, current estimates are doubling and tripling that, right? You're looking at something like that. It's a historic building, it's listed, it's being sensitively refurbished at astronomical cost. There's no way you can run an income approach on something like that, especially when you're replacing assets like for like, which were in some cases built centuries ago. So in that case, using Saudi examples, you're looking at the Gateway to Makkah project, where once again is being sensitively managed, right? In terms of using coral from the Red Sea, etc. Materials which are not readily available or used in construction right now. Artisans who may be specialists because the technology or the style of or the skill set required to reconstruct that may not be readily available. So in some cases, people are trained to do this, or skills are taught to build the property. You look at stuff like that. I'm not sure how you can run an income approach because it's not an income generating asset. So horses for courses, if it is an income generating asset, then by all means use the income approach as your first line of valuations. And in some exceptional circumstances, like you rightly stressed, if the data is just not available, or if market data is not available for a market approach, then you can use the cost approach. I hope that in my long and winding way answers the question.
And I'll just add a little bit to what Paco said, because it will also give us a chance to get the Arabic translation of other questions. So our chair of the Tangible Assets Board is a government valuer in Australia. His name's Kim Hildebrand. He's also very approachable, but he often deals with specialist items of plant and equipment, nuclear power stations, for instance, water filtration plants. It is very unlikely that many of those are that income generating, though they may look at the income approach as part of it. It's also not regularly traded in the market. The barriers to entry, because the cost is in the billions, are so great that it's not like looking at an office block or an industrial building. And in those elements of plant and equipment, probably the cost approach would be the first approach that you go to. And as we're an overarching principle standard, we can't really do a list and say in these countries use this approach for this and that approach for that. It's very much down to your professional judgment and your experience. But judging by the question, if you feel that the income approach is giving you the correct answer, we're not saying that you have to go use another approach. Maybe that is the correct approach, particularly if it's income generating. And even when we talk about the cost approach, so if we look at something like market value, the thing with market value is I'm not necessarily taking into the account the costs that the people are getting themselves. For example, if I was a development company and I had macro economies of scale where I could get all my building materials cheaper, that is not necessarily the numbers that I'm putting into my cost approach, because we have this idea of the anonymous man in the street. You know, what would someone without all those advantages have to pay in their costs? So when you're thinking of the costs you're using, don't automatically take your client's costs, you know, check that they're not getting any special costs or special discount, because at the end of the day, that would not be available to anyone else. I don't know if there's anything you want to add to that, Paco, but I just thought it worth bringing up that point.
Just to give a more regional example, you did talk about nuclear power plants, like what Kim works on. In the region, we basically had to do work where in my previous hat on petrochemical complexes and multi-billion-dollar individual assets, because these are process plants. Once again, it goes back to the licensing and the technology for these ones. You're not going to get market-derived inputs for stuff like that, because the lead-in time for construction is really long. There are few people who can do that. That technology might be licensed from Japan, and you might have people coming in from Japan to build that asset. So once again, when you're looking at that on an income generating, you're looking at that as on an income approach basis, it may be a tricky one. So there are cases where, once again, depending on the purpose of the valuation, depending on the data you have and the reliance on the data, it might be better to lead with a cost approach. Yeah, but a caveat, there are a few cases where you can do that, specialist cases like Alex and I have outlined. I'm not saying go use that as a method of first resort in each and every case, especially when you have abundant or ample market data or information to run a useful income approach. Yeah, thanks. Alex, there's one more question in English, but I'm aware of the fact that we've not given the Arabic questions enough traction. So Mohammed, if we could run through the Arabic questions, if we still have that glitch where Alex can't hear you in real time. I will, yeah, hello, Mohammed, yeah. If we, Yeah, I would prefer one by one so I don't confuse them. So you give me one, I'll translate for Alex. If he still can't get that function working in his interface, I'll do a high-level translation for Alex. He answers it, then we go to the next question. Yeah.
What do I switch to? Do I switch to English to get that function working? I've just got the globe and original audio back out.
Yeah. So Mohammed, can you do a test? Alex, so you can play with the two interfaces, Arabic and then English. And when you can hear Mohammed, just give a thumbs up or say yes. And if it doesn't work, then we'll do what we did earlier on.
It's a very good question. So I'll repeat the question. Does the valuation process vary from one country to another? It shouldn't. Our standards apply to every country in the world and all specialisms. So financial instruments, tangible assets, business valuation. So we believe that everyone will start off with a scope of work or terms of engagement, and everyone will be producing some sort of documentation or report. Where it may differ is if I'm dealing with a financial instrument where I may be doing thousands of valuations a day, I wouldn't be issuing thousands of reports. It would have been in my scope of work that the majority of it would be included in my documentation, and my report might be more limited. So yes, that process does apply to everywhere in the world, and it applies to all specialisms. I'll go to, I don't know if you want to add anything to that, Paco. If not, I'll go to listen to the next question.
No, that's fine. Yeah, that works. I'm in agreement. Yeah.
Okay, so this question was in relation to IVS 105 models. Is there a unified model that can be formed? And actually, my answer would be no. I know that many firms do have their own internal models that they use. I would say use them with cautious. Not all assets are the same. You should check that the model is fit for purpose. I would also add that in some instances, we use model providers. So the standards also relate to that as well. There may be some very complicated aspects of ESG that you might like to model in future. And it may not always be us that uses the model. So what we're really looking at is the characteristics of good model. And you can see within the chapter, we talk about selection of model, model use, model documentation. So no, I wish it would make our life a lot easier if I said, hey, there's this and it applies to everything. But life doesn't work that way, and assets definitely don't work that way. I don't know if you want to add anything more to that.
I agree, Alex. Once again, models are standardized based on the nature of the asset, the purpose of the valuation, and the inputs required. A model will not lend itself to each and every scenario where you can use that exact same model to get accurate outcomes each and every time. So I would say use models with caution. If they are firm models, within firms, they tend to have different models for different types of valuations or different purposes of valuations. So all I'll say is, yes, I'm in 100% agreement with Alex. There's no standardized model where it's one size fits all and you can chuck in every type of asset and have a good valuation. And also the human element and the human input on modeling is very important. All right.
I'm going to move to the next question now. Okay, I'm basically going to cut the question down. What this question is something that Paco and myself have heard in a lot of markets, particularly since coronavirus, which is, do we still need to inspect? I mean, that's basically what I'm hearing is the question, that you have all the documents, the pictures and everything else. Do you actually need to go and see the property? Now, we very much talk in the standard about sufficient investigation. And when I'm inspecting a property personally, because I see it as quite important, I'm not just looking at that property. I might be looking at the locality. I might be looking at other assets around there. I might be getting a feel of the market within that area. Now, we are aware that technology is advancing. We are aware that there's increasing use of drones and other things that may help you to get a lot of the information. And it is largely down to the professional judgment of the valuer, because we talk about sufficient investigation for the purpose of the valuation. Now, my general feeling as old school valuer is I would be like you to inspect everything. IVS leaves it to your professional judgment, but I'll probably hand over to Paco to see if he wants to add more to that, because it's a question we get in a lot of markets at the moment.
In agreement with Alex, what I would say is if you can inspect, then do inspect. But I'm also aware that some client budget and the nature of the valuation will allow you to do that. So once again, whatever a client gives you, if you can run adequate cross checks to ensure that that information can be relied upon, bearing in mind in most cases you cannot plead the fact that the client gave me wrong information because you're supposed to run your cross checks. What I would say is desktop valuations can actually pose more challenges than inspections. So if it's not a question of cost to the client, I'm talking about, say, multinational or international valuations where you need to travel around the world to look at the assets. Or let's say if it's a lower risk valuation, say it's not a fairness opinion pre-deal, and it's a post-deal purchase price allocation where the deal has been done before the anniversary of the deal. You're breaking back the asset values or the purchase price against the different asset classes. It's lower risk. So you can rely on a client within reason to give you information, but you need to run your cross checks. I can give you two examples from my professional practice, right? Property, we're done the material valuations in terms of inspections. It was an update valuation. So we saw it as relatively low risk in terms of the differences or the changes in the assets over the course of 1 year. What the client did was they gave us what was supposed to be the total floor area for the new developments. But the client, not being a valuer and not understanding the basis of measurement, gave us a footprint area. It turned out that that property had basement levels, which you will not see even if you're using Google Maps or doing an aerial measurement, right? And also in terms of the floor plates and the floor areas, some of the floors varied from other floors. So you could very well understate a total floor area if that is what you need to do that particular type of valuation by as much as like basically you could basically be stating 25% or 20% of your total floor area, which will have a huge impact on the valuation. So what I'm saying is, if you're going to run desktop valuations, the onus lies on you to ensure that the client is giving you solid data, and also ask the right questions, because the client with the best will in the world may have given you what they believe to be accurate data, but they are not a valuer. They are not a real estate valuer or a machine and equipment valuer. So as long as you run your cross checks, desktop information can be useful for your valuations and you can still get an accurate valuations. Less of an issue when you get to business valuations, etc., or intangible assets, because these are based more on discussions which you can hold remotely. The added benefit of site inspections is, in addition to you picking up stuff that the client may never have conveyed to you, you can have on-site discussions with the facilities manager, the property manager, or the property owner, which will actually give you more information than just relying on the client's emailing data over to you. Yeah.
If I could just add one point to Paco, and it's a personal experience. So just to show that we're not all at the point that we're at now. When I first started as a surveyor, I worked with the valuation officer agency who deal with local taxation and rating. And as part of that process, we had to agree the areas for the building. And I actually made the mistake that Paco's talking about. I didn't realize there was a basement. So you can guess how quickly I agreed the area at that point. But that is why it is very important to always inspect the property if you can, and not to make those assumptions. So let's move to the next question. So I will just get the translation, so bear with us. Okay, I'm going to hand that question over to you, Paco, because I don't even know what this expert qualification is. So my apologies for that. I'd rather not talk about something that I don't know. So over to you, Paco, to see if
I'll take a chance. Thanks, Alex. I'll take a chance at it. By expert, are you talking about specialist valuations? I'm not clear if that's what you're talking about, but if that is what you're talking about, similar to what the ASC does, where they have specialist qualifications for particular types of valuations, Taqiim has specialist requirements for certain types of valuations. For instance, if you're doing valuations for expropriation or compulsory purchase, or if you're doing valuations in and around REITs, where in some cases is based on the number of years of experience, and in some cases is based on taking a specialist course, like it is for expropriation or compulsory purchase. So yes, there are specialist tracks, not for each and every area, but there are those ones available, and you need to have the necessary skill, experience, either through exam certification or through years of experience and practice in the market to do that. Yeah.
Okay, well,
hopefully that answers the question. Yeah.
We'll move to the next question, but if that doesn't answer the question, just please retype it in. Obviously, there are a lot of different qualifications around the world, and we don't know all of them, to be honest.
Yeah.
Okay, so I'll start off because I got a bit confused by the street bit, and I don't know if you want a comparable for a road or you're talking about your apartment, but I'll just start off with a general statement, which is true no matter what. There is no such thing as a perfect comparable. In fact, if perfect comparables were easy to find, none of us would have a job. So sometimes we have to look slightly further for comparable evidence. I've even looked outside the country I'm valuing in with very specialist assets. Sometimes I might have to look at other types of data. I might be looking at indices. I might be looking at other factors when working out my valuation, but there will never be a perfect comparable. I can't believe that with a standard residential apartment, unless it's the only one in the locality, that there are no comparables. What it is I may need to adjust my comparable evidence in some way. So when looking at rents or looking at sales price, I may have to take into account that my property is larger or smaller, unmodernized, in need of refurbishment. or other characteristics that are relating to it. So when you look at comparables, remember, no comparables are perfect. All comparables will need adjustment of some sort. Even if I've got two identical flats, the transaction could be 6 months apart, and I would have to make some adjustments to reflect any movements within the market in that time. So in terms of a road, I think that it would be unlikely that you would get a comparable for any particular section of road. More likely looking at IVS 300, which deals with plant, equipment, and infrastructure. And you may be looking at more of a construction method with something like that. But I'm going to shift that over to Paco and see if he's got anything he wants to add to that.
Thanks, Alex. If the construction or our interpretation of the question was right, then I believe Alex has totally covered the answer for that. Short of clarifying on what you meant by the road, in terms of comparable data, like Alex said, there's no exact comparable usually, so you need to make adjustments. There have been a few cases, and this is a slightly interesting one where you may have done a valuation of a property. You're doing valuations for whatever purpose another time round, and that property, which is the subject of your valuation, came up for sale, but the final sale deed wasn't signed. So it was sold subject to contract. So that contract didn't happen, and then it fell through. Fast forward a year later, you're doing a valuation of that property. You can actually have that asset itself as one of the comparables to input into your valuation of the asset. So that is as close to a perfect comparable as you can get, but that's a rare situation. Yeah, so I totally agree with Alex in terms of comparables and the adjustments required. Yeah.
Okay, we're going to move. Go ahead. Next question. Okay, that's not the easiest question to answer, so I will answer it as best I can. So there are different models in different countries. So Taqiim is quite unique in the fact that you're also government and you're also regulatory, so the standards are incorporated in law. In many countries, such as, let's take the UK as an example, it will be through the valuation professional organisation. So many of you will be familiar with the Royal Institution of Chartered Surveyors. I'm a fellow of that as a valuer. I was also formerly their technical director. Now, in their valuation standards, they adopt and incorporate the international valuation standards, and then their Red Book provides further standard stroke guidance for their members. In America, you have the model where we have members, the Appraisal Foundation, under which there are a number of societies, and they adopt IVS. And you'll also notice that both the IVS website and on the Appraisal Foundation website, a bridging document that shows how you can comply with both the international valuation standards and USPAP. It's a document that I helped write, so I'm sure it's very good. So please enjoy reading it. But it makes the point that, you know, it doesn't matter whether you follow USPAP, IVS, we'll all come to the same result at the end of the day. The difference is we do slightly different things at different times. So we have to start off with competence. They could do competence during the process. We refer to special assumptions. USPAP refers to extraordinary assumptions and hypothetical conditions. If I go to Australia, the Australian Property Institute fully adopts IVS, but again, it's through their professional organisation. So we've got one model where it's in law in Mexico, in the Kingdom of Saudi Arabia, And in other countries, we've got another model where it's mandatory through your professional body and through your professional requirements. And then others will have, like the Norwegian Wealth Fund, will demand that their valuations are done according to IVS. So there is not one model as such. I can tell you that our standards are adopted and used around the world. I can tell you that we have over 200 member organizations, which include all the countries that you're talking about. At the moment, we are actually on a personal journey with IOSCO, who are the global regulators who are reviewing our standards. And we very much hope that through that journey, a bit like IFRS, they could eventually be incorporated into law. But at the moment, they are regulated and adopted by either the professional bodies in which country they're located, or they're incorporated in the government through law, Mexico, the Royal Kingdom of Saudi Arabia, or they are required by investors such as the Norwegian Sovereign Wealth Fund, who would demand it for their valuations, or others. So it's quite a general answer because there is no one size fits all. I don't know, do you want to add any further qualification, Paco, or do you think that that deals with that?
Thank you, Alex. That was actually a very good answer. Yeah.
So let's go for the next question. Okay, so we've got a lot of, we're obviously in a consultation at the moment, and providing, you know, we can deal with all the responses that we've received from the consultation, we would be looking to publish the next edition in January 2024. But I'm also aware from discussions I've had with other stakeholders, they might like the implementation date to be slightly later. So normally the implementation is 6 months after the standard is published, though early adoption is always encouraged. I've heard some suggest that we should push it out to 12 months to help people. No board has yet made a decision on this. So first of all, the first step is, please send us your responses. And if that's something you feel particularly strong on, there's a question in relation to that. You can go on the website, you could just answer that one question if that's what you want to answer. You know, you can answer anonymously, you can answer as a member of an organization. Just go on www.ivsc.org. But normally we're published in January 2024, effective date would be July, but my assumption is due to the comments that we've received, we may make the effective date slightly later, but this will be very much discussions for Paco, myself, and all our board members to have before making any decision in relation to that. Happy to take the next question.
Alex, Mohammed, just a slight pause on that. With that question, I actually realized we still have quite a ways to go on the presentation, because that question is answered towards the end of the presentation, right? So with depending on your thoughts, I was thinking it's better to go through a few more slides, and then we'll take the next round of questions. Just
okay,
so.
What I'm going to do, and please all bear with me, is I'm going to cheat, because as you can tell, I can talk for hours. I'm going to go through all the rest of the slides very quickly, and we're going to get through them in about 8 minutes and then focus on your questions. So next slide, please.
Sounds good.
I'm just really going to talk about the revisions here. IVS 100 valuation framework. It's really important as a sort of framework to all valuations. And the main new bits here to look at are quality control. Quality control is an extremely important part of our process. Without quality control, we can't ensure that the valuations are fit for purpose. We believe that it can be done by sole practitioners as well as people within firms. Have a look at this. We've also included specific requirements in relation to use of a specialist and use of the service organisation. Next slide, please. No real changes in this chapter. The main change is that under the valuation requirements for scope of work, we've included intended use, ESG, and the reason we've included that is we're being asked to do a lot of things in relation to ESG, including stop climate change. Not all of these are possible. So just be very clear about what you're doing and what you're not doing in relation to ESG. We're still in a data gathering exercise. You want to make sure that it's fit for purpose. We've also added the requirement, the type of report or other documentation being prepared. And the reason we put that is not everything has a report. Take the example of financial instruments, and also we might be asked to use specific pro formas. So we wanted to give that flexibility that you could use a specific pro forma and still be compliant with the standards. Next slide, please. No real changes, but some of the content has moved to the appendices to make sure that it relates to all asset standards. Next slide, please. No real changes here, but what we've done is we've tried to differentiate between approaches and methods. We noticed that many markets were confused by that, so the approaches are in the main section, the methods are in the appendices. Next slide, please. This is very important. This is a new chapter. I promised I won't go into detail, but what you'll notice here, and please look through it in your own time, is we talk about the characteristics of suitable data and inputs. And I know this is a challenge in the Middle East as everywhere else. We talk about accurate, appropriate, complete, observable, timely, transparent. The job of the valuer is to maximize as many of these characteristics as possible. But of course, no data, or very limited, will have all these characteristics. I don't think I've ever seen them. I'm not sure if Paco will have either. But what you should do is try and maximize the characteristics and talk about your data and input selection and the reason why you've done it, and also document it, because that will protect you. If people say, oh, you didn't consider this, you didn't consider that, you can say, yes, I did, and here it is, it's on my file. Next slide, please. I'm going to take a little bit longer on this because ESG is a very important topic. So first of all, we've got a lot of regulation coming from everywhere at the moment. And therefore, it's very clear that the valuer must be aware of relevant legislation and frameworks in relation to environmental, social, and governance factors within their valuation. So if you were doing IFRS, financial reporting, there's some requirements there. If you're reporting in the Royal Kingdom of Saudi Arabia, there will be requirements within that market. So it's the valuer's responsibility. I also wanted to point out the two sections that are shown here, 10.7. Now, what is really important about this section is all known or readily available ESG information which would affect how a market participant, I'll pause there, how a market participant would assess the value of an asset and what they would pay for an asset should be included in each valuation. So we're not asking you to do anything different than what a normal market participant would do when you're looking at what ESG information to include or not include. And also 10.8, the ESG regulatory environment should be considered in valuations to the extent that they are measurable and would be considered reasonable by a peer applying professional judgment. Next slide, please. We talk about characteristics of models. Models and data are very much interconnected. You can see here the characteristics: accuracy, appropriateness, completeness, timeliness, and transparency. The aim of the valuer is to maximize as many of these characteristics as possible. You've also mentioned types of model. You'll notice here that there is a section in the grey box on model selection. So you could say, I've used my firm's standard model, but you'd have to justify it, but you do have to explain the model that you use. You've also got to explain valuation model use, how you're using that model, and the documentation is very important. Next slide, please. So number 106, the main thing that I want to tell you is there's a new section here on documentation. Documentation protects you, it's greater information than in the report. We also talk about additional requirements for valuation reports, ESG, significant or special assumptions and limiting conditions. findings of a specialist or service organisation, value and rationale for valuation, and IVS compliance statement. I'll just stop on 3 of those. ESG, in your scope of work, say what you're doing. In your report, say what you've done. The 2 should match. So it's very much a protection for you. Value and rationale for valuation, and I'm sure Paco gets this problem that I do. We are absolutely terrible at valuers at putting down our rationale. Now, if I speak to a valuer and say, oh, tell me about your valuation, why did you do that? How did you do it? They can give me chapter and verse, English expression, meaning they can tell me everything. But when I look at the report, none of that information is there. You need to put your rationale within your valuation report. And if your report is IVS compliant, you should state it. Now, before continuing, I'm going to pause and go to Paco, because I'm sure that may be an issue and you may want to add something about rationale for valuation in terms of the reports that you see.
Thank you, Alex. Just to buttress Alex's point once again, skill and experience of the valuer will not wash in a lot of cases if it's not documented and if the rationale is not clearly outlined in your valuation. So in your valuation report, be as explicit as possible. Be clear, be transparent, all right? I know there's parts of it that would blow to the valuation report, so you might keep them on file. But especially for certain purposes of valuations and reasons of valuations, the more justification you put in there, the more it will pass the review process, be it audit review, auditor's review, or be it peer review. So you need to outline the rationale. Skill and experience, all well and good. Subjective adjustments, yes, there's a place for that. But if you can put in adjustment grids, if you can clearly explain how you adjusted the comparable data or the market data that you derived, it will go a long way towards basically answering all the questions a reviewer may have. And also, interestingly, especially for informed clients, it gives the client more comfort around your valuations, so they're less likely to challenge it, right? Especially if the value outcome is not necessarily what the client was looking for, be it higher than or much lower than what the client was expecting. If there's support in there, if the rationale is clearly outlined, it does your work for you. So you don't need to then have to submit reams and reams and reams of data or information after the fact, trying to defend something which you didn't justify appropriately in the beginning. Yeah, thanks.
Okay, I'm going to just quickly do one more bit on this, and then I'm going to be really speedy through the rest to make sure we get more of your questions. So I know that Taqiim has its own requirements on valuation reviews. I know that they're far more extensive than ours. In fact, I think we've got a standard in the whole book. In terms of IVS, we just see 2 types of review. We can only deal with review with IVS compliance, not Taqiim compliance. So please follow the Taqiim rules. But we see a process review where you're looking at the process and seeing if it's compliant with IVS standards, and a conclusion review, that is where you're reviewing one or more elements of the valuation to check their fit for purpose, such as the comparables used, the yields adopted, growth rates, etc. However, I would give one caveat here. If your client is asking you to give a new value, that is not a valuation review, that is a valuation. And as far as we're concerned, all the requirements of a valuation would apply. So I can review the process, I can review components of my value, but as soon as they're asking me for my opinion of a value, a review is not a cheap way to get a valuation on the cheap. You will have the same liabilities and everything else if you offer that figure. So it is a full valuation. You should have a full instruction and a full fee. I don't know, Paco, if that's an issue or you want to add anything more on that, but I always like to highlight that point.
100% agree with that. Any information your valuer gives on behalf of the firm or as an individual valuer, and the client places reliance on, it's going to be hard for you to then plead the defense of I was just giving him my thoughts or giving him some friendly advice. So all I'll say is don't do valuations on the cheap. don't let the client push you into giving a parallel valuation or a new valuation under the guise of a review, because that's not what it is. If it is a valuation, treat it as a valuation, bill it and charge the client appropriately, and make sure you put in all the relevant caveats that will cover you for your valuation, because you give a value opinion, you own it, and you're responsible for it, including the liability for it. Thanks.
Brilliant. If we can go to the next slide, and on the next slide, I'm actually going to cheat. So rather than go through all the individual slides, I'm going to tell you everything that you need to know about these chapters from this slide, and then we'll move to the end of the consultation so we can take more of your questions. So looking first at the business and business interest series, or business valuation series, which you will notice as the numbers IVS 200 to IVS 230, there have been no real changes to these chapters. References have been updated in line with the revisions to the general standards, and as a result, there have been a few consequential amendments. Looking at IVS 300, plant equipment and infrastructure, what we've really done here is we noticed that it seemed to lean too heavily on the cost approach. It seems to reflect some of the discussions we've had here. So what we've done is we've rebalanced it slightly, and we've extended the sections on the market and income approach. Other than that, we've restructured it as per the general standards. We've put new sections on data and input, new section on valuation model, and the reporting section now includes documentation. In terms of IVS 400, that's real property interest. We've also restructured this as per the general standards. We've done a new section on data and inputs, a new section on valuation models, and the reporting section now includes documentation, but there's no great changes to these chapters. In terms of IVS 410, development property, once again, we've restructured it to follow the general standards. We've increased the references to land. For some reason, people didn't realize that development property included land, so we've clarified this by providing more examples. We've got new sections on data and inputs, new sections on valuation models, and the reporting section now includes documentation. In terms of IVS 500, financial instruments, this is a totally new chapter. Please, if you are in that field, if you deal with FI, read it fully, give us your comments. So if I could ask you, Paco, just to go to the last slide, or the one before last slide that gives the dates of everything. I think it's slide 31. We can then spend the last 10 to 15 minutes taking people's questions, which is the bit that both of us really want to do. So we can probably go slightly beyond this slide, Paco. I think there would be one that says the dates or something. So that's how you can respond. You can do it via an email to me. You can respond on your website. You can attach a website to the a response to the website. And if we just move one more slide, I think that might show the, yeah, here you can see the potential key dates which answer that question. So maybe shall we go over to Mohammed for more questions now, Paco, so we can answer a few.
Mohammed, one pause just before we move to the questions. First off, thank you very much, Alex, in terms of how you've laid it out. So just a quick recap for our members who are watching, and also so you basically provide constructive feedback on the IVS standards as exposed. The key sections, apart from the fact that the general flow has been restructured to mirror the valuation process, the key new inputs in there are data and inputs 104, valuation modeling 105, documentation 106, and EXG has been woven through all the general standards and the asset standards right now. In terms of the flow of the asset specific standards, 200 all the way through to 500, some of them have been tweaked, others have remained largely the same, but given as the general standards have all been, anything that's general has been moved to the general standards. What I would say is pretty much every asset specific standard has been touched in some way, shape, or form. So review the ones that apply to you, give us constructive feedback towards improving them and making them more applicable to your areas of practice, because it is a document. There's practical inputs that have gone into it, but it's always good to expose that document to the practitioners, the users of the valuation standards themselves, so you can give us constructive feedback towards improving it. And with that summation, we'll move on to the rest of your questions. So Mohammed, over to you.
Okay, so
Alex, can I take a first stab
yeah,
at that?
go
And then
first.
you can follow up on that. All right, so you clearly stated that if the income is very weak, I'm not sure what you mean. If it's an income generating asset, I don't know whether you mean you don't have enough income inputs to run an income approach, or as may very well be the case, you can actually run an income approach and have negative cash flows, right? That is something a lot of valuers do not like to hear. They believe you run a valuation analysis, you should always come out with a positive and come out with a value. Depending on that stage of development or the risk associated with the assets, you can very well run a DCF and your conclusion will show negative territory in terms of the value. It doesn't necessarily mean you've run a wrong DCF. It just means that it's not generating enough income. And there are some properties which will just never generate enough income to basically justify their being there on an income basis. Hence, you have certain assets where beyond the income, for example, I'm going to give you like heritage assets. It's not necessarily about its ability to derive income. It's for a wider societal use. It taps into the culture, the history, and the heritage of a people. It may not be profitable, but it still has value, right? So just be worried about the income approach. The fact that it gives you a lower or in the end negative, or in some cases negative value, doesn't necessarily mean you run it wrong, right? If it is the right approach for that asset.
I mean, the only thing that I'd add to Paco is sometimes you can realize that there's not that much security of income. For example, the tenant may not be that stable, etc. That is the great advantage of a cash flow. It allows me to make all sorts of assumptions in relation to voids, reletting periods, refurbishment costs that may be needed to get a unit back into condition. We are aware that we are in quite challenging times. We are aware that there have been quite a few premises where people have gone into liquidation, could be hovering on the point of liquidation. As Paco says, that shouldn't stop you from doing an income approach or a cash flow. It just means that I may have to look at, review, and include further assumptions in relation to that. And it's quite common in all markets, you know. I mean, particularly if I'm looking at retail at the moment, retail has probably been the most challenged of all our asset classes over the past few years. Most of us go into shops, try things on and buy them online because it's cheaper. This has had its effect as well. And so when I was doing that, that income may not be so assured, and I may have to look at it. I may have to look at the market rent and other factors in relation to that. So that's the only qualifier I'd give. I don't know if you want to add more to Paco, but that probably covers both ends.
Yeah, that covers both ends. Thanks, Alex. Mohammed, can we move on to the next question, please? I think we already did that question, yeah. Mm-hmm.
While you take some other questions, I'll pick up a few English ones. Are there completed reports for inspection and viewing by following the standards to obtain a total of values for the same property? I think what that's asking, Paco, is do we have, I think what they're asking is, do we have example reports? We tend not to do example reports because the problem with example reports is everyone copies them and suddenly you see it used in reports where it's not actually relevant. We also tend not to supply illustrative examples because we've noticed that if I do a cash flow, do it as an example and put in a 10% discount rate, suddenly every cash flow that I will ever receive from everyone would have a 10% discount rate. Are there examples available in the market? Yes. Are there examples of good and bad practice? Yes, probably. I don't know if Taqeem does any examples of this is what good looks like and this is what bad, but we don't do that at IVS.
I totally agree with Alex, the risk of putting in illustrative examples, because we've seen it in cases where a candidate may be coming up for examination and they basically lift something straight out of one of the courses, lock, stock, and barrel, and put it into the evaluation report without making the relevant adjustments. Like Alex said, if you have an illustrative example and it's using, say, an 8% discount rate, it doesn't mean for every single valuation of that asset type, 8% as a discount rate is applicable. So yes, I'm in total agreement with the IVS not putting in illustrative examples. Like Alex also said, once again, there are examples in the marketplace. You can build your models. There are professionals who can help you build your models, or you can work with organizations where you contribute towards the building of models and how to model stuff. But I would be wary of illustrative examples because they're just meant to be that, illustrative. It's not an answer to your valuation problem, which you then need to find a solution to. So just be wary of using illustrative examples.
I'll pick up a few of the important ones while we wait. So there's another one here. Are there any specific guidelines that regulate the process of reviewing valuation reports as an expert for financial reporting purposes? Now, I'm assuming that you're referring to what I would call being an expert witness in some way. There's several caveats that I'd give you. One, competence, not saying that you're not, I'm sure you are, but this is a highly sophisticated part of the valuation world. If you are actually reviewing stroke auditing reports for financial reporting purposes, there will be particular requirements for that. There will be particular standards in relation to that. It may be worth sending Paco a separate email just so you can check that what you're being asked to do is actually possible, because I would say proceed with caution would be my answer. I don't know if you want to add anything to that, Paco.
Thanks, Alex. What Alex said is the requirements for financial reporting review tend to be a lot more robust than for other types of valuations. So you need to be careful. Bear in mind that usually, even if the assets are tangible assets heavy in terms of the overall business enterprise value, they all slot together. And there are cases where the intangible assets will have an inverse relationship with components of the tangible assets. So you need to be careful in terms of review work around that, or also doing work around that. So yes, drop me an email through Taqeem's communication portals. As far as I can answer your question, I will answer your question. But yeah, so that's it. Yeah, so drop me an email and I will give you as much help as I can in and around that.
So I think we're on the hour, Paco. I mean, I can happily stay, but I also have to be respectful of other people's times as well. So we'll happily take questions outside this that we can respond to as well. So back over to you.
Yeah, thank you very much, Alex, for your time. And yeah, I mean, 2 hours is quite a big ask given your busy schedule. So thank you for your time and thank you for your contribution to this consultation on the exposure drafts. Thank you very much, Mohammed, for being a very able interpreter and for helping us with Arabic questions. And thank you, audience, for participating. Like Alex said, you can drop him direct questions and you can also drop me direct questions through the Taqeem communication portal. And we'll do our very best to answer those questions for you. So thank you very much. Salam alaikum, all of you. And that's it from us.
Thank you. Masalama. Salam alaikum. Thank you. Shukran kathir.
Thank you. Bye-bye.